talking about capital gains on mutual funds and how you can offset it. Also, a little bit later, Hemant Rustagi, CEO of Wise Invest, will join in to talk about the difference between saving and investing. Yes, they're not the same. So what is the difference and what do you need to know? But first up, let me welcome Rajee Rajesh. Hi, Rajee. Thanks very much for joining in. There is some confusion because interchangeably we use the terms income earned from mutual funds and capital gains. So first up, can you tell us what is the difference and also the tax structure?
Okay, so when we invest in mutual funds, normally the returns can be generated or realized in two forms. There could be dividend payments from the mutual fund companies, or the returns are also in the form of capital appreciation. That is, the NAV of the mutual fund units appreciates. Now, dividends, the taxation is pretty simple. Whenever a dividend is paid out, it is taxed in the hands of the investor as per the tax slab that the individual falls in. But capital appreciation is taxed only on realization. That is, you have to pay tax only in the year in which you redeem the mutual funds. Now, this taxation, the quantum of taxation, depends upon two important factors. What is the nature of the mutual fund that you're selling? Here, we have to classify mutual funds as equity-oriented mutual funds and debt funds. Debt funds would include any fund of fund or gold funds also. And equity funds would include arbitrage funds and balanced advantage funds. So this factor is very important. We need to understand what category the fund falls in and also the holding period of the investment. Depending upon the holding period, the investment will be classified or the gains will be classified as short and long term. Now, if we take debt funds, the holding period, if it is less than 36 months, then the gains are reckoned as short-term gains and there is no change in taxation. The tax is as per the tax slab of the individual. But when debt funds are held for a period of more than 36 months, then they are classified. The long-term capital gains arising out of such redemption of debt funds is taxed at a flat rate of 20%. And also there is a very favorable indexation allowed, just as you have for immovable property. You can index your cost of acquisition. So the tax impact is almost negligible when you redeem debt funds after 3 years. Now, if we move to equity funds, the taxation is quite different here. Here, the period for reckoning whether it is short-term or long-term is also 12 months, which means if you sell a fund within 1 year, you would have to pay tax at a flat rate of 15% because it's short-term capital gains. But if you hold a fund for more than a year and sell it after, then long-term capital gains kick in and that flat rate is only 10%. And here again, the investors have an advantage of availing an exemption of 1 lakh in respect of long-term capital gains every financial year.
All right, Rajee, thanks very much for explaining that. But when we talk about capital gains, it's very important for investors to also understand the concept of grandfathering. This was a new concept which was introduced in the 2018 budget. So what does it mean for investors? How can they use it?
Yeah, so earlier, prior to 2018, as per our income tax structure, any gain, long-term or short-term gains, or long-term gains at least from mutual fund units redemption, was completely tax-free, especially equity mutual funds. Now, this taxation of 10% on LTCG on mutual funds, equity mutual funds, was introduced in Jan 2018. And generally, grandfathering is the name given to a provision in which you have an old rule applying in some special cases whenever a new rule is introduced. This is what is grandfathering. In this particular context, the government did not want to penalize or increase the tax liability of investors in respect of the gains accrued to them before 31st January. On 31st January or on the budget of 1st February, this long-term taxation on LTCG was introduced. So the government allowed a facility called grandfathering, wherein when you are selling mutual fund units, you can split your gains into gains made before 31st January and after 31st January, and you are required to pay tax only in respect of the gains accrued after. If I take an example, supposing you have invested, say, 1 lakh in mutual funds around 2010 or something, it's quite likely your value of the mutual fund would have been, say, 4 lakhs by 2018. And then you sell it after a couple of years. Say you sold it last year for 5 lakhs. You invested 1 lakh and you made 5 lakhs. So your capital gains would have ideally been 4 lakhs. But since the taxation was introduced only in 2018, by grandfathering, you would be required to pay only tax on 1 lakh, which is the difference between the value of the fund on 31st January and the value on the date of sale. This is a facility available and it's known as grandfather.
Okay, so Rajee, now tell us, how do you offset capital gains, both long-term and short-term?
Yeah, this is again a very important concept because equity markets are subject to volatility and it's quite likely there might be loss on sale of certain securities. So if an investor makes a loss on sale of his units, equity-oriented mutual funds, he is allowed to adjust such loss against gains. He might have sold some investments at a loss and some in a profit. So this loss and profit can be set off and you are required to pay tax only on the net capital gains. But here some rules are applicable. It says that long-term capital loss can be set off only against long-term capital gains, whereas short-term capital loss can be set off against both short-term and long-term capital gains. So which means you have to be careful when you try to adjust long-term capital loss, whereas short-term capital loss can be adjusted against any form of gain. Another important aspect is, if you are supposing not able to achieve this set off completely in one particular financial year, you don't have gains at all, whereas you have made losses because the markets have been dull through the year, you're allowed to carry forward these losses and set it off against future gains made for you in the subsequent financial years for a period of up to 8 years. So this is a very important facility and investors should be careful of carrying forward this losses, capital losses in their income tax returns. And for this very reason, even if you don't have tax liability, it makes sense to file your returns because this facility of setting off, carry forward and set off is available only if you file your return of income.
Okay, but Rajee, how much emphasis should investors actually give to the tax impact when they're looking to make portfolio decisions? How important is it?
See, taxation is a big factor to be considered while you're assessing returns on your investments. Supposing your tax-adjusted returns should only be considered while making a choice between investments. For example, fixed deposits could give you 5.5–6%, but if you end up paying 30% tax, your net effective rate of return is 4%. So this is a very important factor. But when we come to making portfolio changes, again, we have to be aware that whenever you make a change, you have to pay a tax on the realized gains. So frequent churning should be avoided. But typically, the circumstances when we have to absorb the tax and make the change in portfolio or within mutual funds is when you require funds for realization of your goals. Obviously, you have to sell the mutual fund and use the money. You have to pay the tax. Sometimes when you decide to move from an underperforming fund or an underperforming sector to another sector, those kind of changes which are driven by performance considerations, also you have to absorb the tax impact. And of course, if there is an asset allocation change that you have to do in your overall portfolio because your equity has suddenly become very high or you want to increase your equity component, those kind of changes would also require you to, in those cases, you would have to absorb the tax impact and then make these changes. Otherwise, frequent churning should be avoided because the taxation impact would be high on such kind of transactions.
Okay, and Rajee, finally, can you leave us with some tax planning ideas?
Yeah, so a couple of things which investors should keep in mind is, especially when you don't need your fixed income allocation for a period of 3 years, debt mutual funds are a very important factor to consider because they are very, very tax efficient. If you hold them for a period of 3 years because of indexation, you end up not paying any tax. So an allocation to debt mutual funds, especially for individuals who are in the tax bracket of 30%, is very important. And then there is something called capital gain harvesting, where if you're having profit-making securities, I told you earlier that there is a exemption of 1 lakh in respect of every individual has a 1 lakh exemption every financial year. Now, you cannot accumulate this over 2–3 years and claim it. So it makes sense for you to book your profits up to the tune of 1 lakh in every assessee's name. Supposing you're a family of 3, you're investing in your name, the name of your spouse and an adult child, then in that case, booking profits in each of their portfolios and harvesting this gain to the extent of 1 lakh every year makes a lot of sense because you would be saving tax to the extent of that 1 lakh in every assessment. And finally, of course, now that dividends are taxable based on your tax slab, it is advisable not to use the dividend option at all in mutual funds. If you have some funds still lying in old dividend options, please make a switch to growth funds. And if you need regular income generation, Systematic withdrawal plans or SWP mandates are a more efficient way of drawing the money and saving tax.
Rajee, always a pleasure to speak with you. Thanks very much for explaining this concept. On that note, a very quick break. On the other side, we'll connect with Hemant Rastagi, CEO of Wise Invest, who's going to talk about the difference between saving and investing. Stay tuned.